March 14th, 2017. And this is going to be a webinar mainly on how to use weekly moving averages. The goal of this webinar is to help you better identify long-term entry points on your trades or investments. Everyone knows about daily moving average, but lesser used are weekly moving averages. Now these are just like daily moving averages, except they compute averages based on weekly closes instead of daily closes. I'm going to focus on the 50-week and 200-week moving average. Now, why would I look at moving averages like the 50 and 200 as opposed to just looking at a 50-day and 200-day moving average? Well, number one, I think weekly closes are more important than daily closes. A lot of veteran traders talk about drowning out the noise and how a lot of noise happens during the week. And my mentors, I know other veteran traders with a lot more experience than me, they focus a lot more on where a stock closed the week as to where a stock closed the day. You think back to instances like the flash crash back in August 2015. That was a very volatile day, but by the end of the week wasn't all that bad. Another reason is the weekly moving averages can offer you a different perspective over a different time frame. You might have a daily chart that shows a stock going down with no end in sight, but you click over and look at the weekly chart, and all of a sudden one of those weekly moving averages signals that this might be a good long-term entry point. Number three, and my favorite reason for using weekly averages as opposed to daily, is they are a less obvious indicator. The first two indicators taught in any book, and if you go to stockcharts.com, the default indicators are the 50-day and 200-day moving average. That means a lot of noobs and a lot of novices are looking at those daily moving averages, whereas weekly moving averages can offer us a simplistic edge over less sophisticated traders and investors. So, as usual, the best way to kind of drive this lesson home is with a handful of examples and kind of show you guys where the 50-week and 200-week moving averages did some good things for us as opposed to just relying on the daily. So what we're looking at here is an example on Facebook from November 2016, just about 5 months ago or so, around the election. That's on the left-hand side. And on the right-hand side is a Facebook weekly chart. Notice in November this big move down on Facebook from about 130 all the way down to 116. Stock crashes below the 50-day moving average and then goes on to lose the 200-day moving average. Two technical red flags when you look at that daily chart. However, if you look over on the right side and we look at our weekly chart, we've got the 50-week moving average, that's this purple line, and the 200-week moving average is this light blue line. Notice that big crash on the daily took us down to a perfect spot on the weekly in terms of an upward sloping 50-week moving average. Stock churned around that 50-week moving average, which continued to slope upwards even into the decline, which is important because notice the daily averages started sloping downwards on the 50, but the 200-day maintained upward slope. So while this consolidation was going on and while it might have looked bearish on the daily, this 200-week maintained upward slope offered good support. And if you looked back in early 2016, you saw that 200-week offered good support as well. And again, in the fall of 2015 rather, offered good support. Good example of that entry point being provided via the weekly moving average as opposed to the daily moving averages, which might have looked bearish on Facebook. Another example, all of these are going to be side-by-side views with the daily chart on the left-hand side and the weekly chart on the right-hand side. You look at Google here. Left-hand side, we lose that 50-day moving average in November around the same time that Facebook lost the 50-day moving average. But it was kind of holding the 200-day moving average. And this brings me to a point number one in the lesson, what I like to call time frame collision, where we're testing a shorter term moving average, the 200-day, and then if we go over and look at the same period on the weekly chart, we were also testing the 50-week moving average. So the longer term time frame chart, the weekly, and the shorter term time frame chart, the daily, are giving us a collision here between the support at the 200-day and the 50-week. I love when our time frames collide like that because it gives us an even stronger level that we can trade against with greater conviction. Notice again, 50-week was maintaining upward slope into this test. And in prior instances in July, Google held around the 50-week moving average as well. So another one where the daily looks like a possible breakdown brewing, but the weekly showing very strong support around that 50-week moving average. Now here's one of my favorite examples, and that's JPMorgan. This is from the beginning of 2016. If you remember, it was very, very shaky in the market. Look at this gigantic fall here on JPM. On the daily chart, we're around 64, 66 bucks. We have a big time move down towards 54. Now here's where the weeklies can save you some money, but also help make some of that money back. So look over at our weekly chart on JPM. We lose the 50-week moving average at the same time as we lose the 50-day and 200-day moving average. So again, kind of that time frame collision, this time in a bearish instance. So it's a bearish signal when we lose that 50-week aggressively along with the 50-day and 200-day. However, where do we find support after that 10, 11 point drop? Right around an upward sloping 200-week moving average. And if you notice this candle here, this big long wick, that was the August flash crash in 2015, which again found extreme support at the 200-week moving average. Notice the slope on this JPM 50-week is a lot flatter compared to our Google and Facebook examples, showing a less bullish trend in the shares. If we go back to Facebook, for example, you could see our slope was steeper to the upside as opposed to JPM. When we lose it, it's a flatter slope. The takeaway there is that slope matters. If you lose an uptrending, an upsloping weekly moving average, it isn't nearly as bearish as losing a flat or downtrend sloping weekly moving average like JPM did in this instance here. But again, we find support at the upward sloping 200-week moving average. Daily looked real sloppy there in January. Now if we move along on JPM, we see this nice test in July 2016 on the weekly, and then a breakout in the fall, September, October. Nice clean breakout back above that 50-week moving average. And if we go back to our daily chart, we'll see some more time frame collision here, where here's the regain in July of the 50 and 200-day moving averages. Here's a nice test of the 50-day moving average in early August. You look at what JPM's doing at that time, it's regaining the 50-week moving average, retesting it, and holding it. And most recently for JPM, it just kind of took off to the upside off that 50-week hold. And you look at this daily chart, obviously she's just been a monster. Next example is from Apple. Apple held her 200-week moving average beautifully during various points of 2016 and recently regained and based its 50-week moving average. Check out another time frame collision example here from November 2016. Apple takes a pretty good dip down from 118 down to 104. We lose the 50-day moving average on Apple, but we find support right around that 200-day moving average at about 104 during this period in November. What does that coincide with? That's this candle right here on Apple, where the weekly takes a leg down and we find support right at that 50-week moving average just as it's starting to curl its slope back to the upside. All the while the 200-week moving average is remaining in a strong upward slope. And if you look at Apple on the daily and we go back even further in 2016, you see more examples of where the 50-week can kind of help save us some money and then help us make that money back. So if we look at October 2016, we have a big drop in Apple, October, November, where we get rejected at the 200-day moving average, and then later in December lose the 50-day moving average, and both the 200-day and 50-day start to slope lower. That's this action right here in Apple. Notice it comes up to its 50-week moving average, fails to regain it on a flat slope, and then that slope rolls over, again rejects in April 2016 into a declining sloping moving average. But where are we finding support all the while throughout 2016? At that 200-week moving average, which maintained an upward slope, and now the stock's just been on fire. Now let's look at an example where everything starts downtrending. We've looked at mainly bullish examples here, which is what happens when you have a very bullish stock market like we've had over the last few years. But we're going to look at Gilead right now, G-I-L-D. This is a biotech stock that's kind of fallen from grace a little bit. And we are looking at the summer-fall months in 2015 on our left-hand daily chart here. I want you to note this action right around there. That's a bad pen color. This action all around here on Gilead where we lose the 50-day, the 50-day starts to slope lower, and then we also lose the 200-day, and the 200-day has no slope. It's no longer an upward sloping 200-day, it turns into a flat sloping 200-day moving average. Well, if we look over at our weekly chart, that's this action right here, where we test the 50-week moving average, but now it's a flat sloping 50-week moving average. It's not an upward sloping moving average like it was in early 2015, late 2014. Then we lose that 50-week moving average, coinciding with the loss of the 50-day and 200-day moving average. So again, time frame collision, where we're having some coinciding negative signals showing up on the daily from the moving averages and from our weekly moving average. And as we go into 2016, we're trading below what has now become a downward sloping weekly moving average and trading below what are becoming downward sloping 250-day moving averages as well. So at that point, we're looking bearish. And look at this great rejection by Gilead when it finally stages a good bounce off of those January lows, goes from 80 bucks up to 100 bucks. You think, oh, the stock's bottomed, right? Now, if we go look at the daily chart over here, you can see that the stock again gives us a great time frame collision where this test of the 50-week moving average right here is coinciding with a beautiful rejection at the 200-day moving average right here, which I would point out is still downsloping along with a downsloping 50-week moving average. Great rejection right there. Great example of how this doesn't just work on the bullish side of things, it can work on the bearish side of things. Gilead has gone on to lose the 200-week moving average as well, and the chart just doesn't look good. And now what I also like about this is it gives me something to watch for a bottom. I wouldn't look at Gilead technically until it can start getting constructive price action back above this weekly moving average, which is currently around 77 bucks. Final example here is from Nvidia. We're looking at a daily chart on the left side from early 2016. Now, to set this up, I want to show the weekly chart because this is the breakout we're looking at, where the stock goes from 20 bucks to about 35 bucks, makes a big time move, big time breakout, but then has a big pullback from 35 down to about 25. Notice here on the daily chart, we get that time frame collision again. Beautiful test at the 200-day moving average, which is doing what? It's upsloping, coincides beautifully with a test on the 50-week moving average, which is also upsloping, as well as the 200-week, which is sloping higher. So just another good example of those time frames colliding where, hey, stock breaks out. Now all of a sudden it looks pretty bad on the daily, right? 10-point drop, that's not very good. Well, actually, if you zoom in and you look at that weekly chart, really what we have here is a picture-perfect doji candle right at that 50-week moving average, followed by a great reaction higher off of it. So, some key takeaways from these examples. The first takeaway is that slope is important. The slope meaning the slope of the moving averages, be it the 50-day, 200-day, or 50-week, 200-week. Being below a 50-week and 200-week moving average that is downsloping is more bearish than being below a 50-week and 200-week moving average that is upsloping. So for example, if we go back to Gilead loses this 50-week moving average in late 2015, and then it starts to slope downwards in 2016. That's not a great sign. And then we get that beautiful rejection around April, May 2016, while being below a downsloping 50-week moving average. If we look at Facebook technically does get one or two weekly closes below the 50-week moving average. But the difference between this Facebook and that Gilead is that on those closes, the 50-week is still upsloping. And it's the same thing with Google. Google technically gets a couple closes below the 50-week moving average at various times in 2016, but on those closes, the 50-week is still uptrending. I don't know why it's more important, but I can tell you from observing and studying that time and time again, it ends up being a lot more significant when you're below a downsloping 50-week moving average, like in our Gilead example, as opposed to our Facebook and Google examples, which are above upward sloping, which are below upward sloping 50-week moving averages. The next key takeaway is time frame collision. When you've got a key test on the daily chart, you're testing the 50-day, 200-day at the same time as a key test on the weekly chart, then that gives you an even stronger setup, such as that Nvidia example where we're getting a great test on the 200-day, also coinciding with the 50-week. Or like on Google, when we're getting a great test on the 200-day back in November, coinciding with the 50-week back in November also. That confluence of indicators, I call it time frame collision because we have a short-term setup as well as a long-term setup. I like that. Gives us more conviction behind the trade. The third takeaway is that space is important, meaning you have the most bullish stocks. The most bullish stocks will have the greatest amount of space between the 50-week and 200-week and the current price. For example, if we look at Nvidia, you have a tremendous amount of space. The 50-week is nearly double the 200-week moving average. Actually, in fact, it is more than double the 200-week moving average. And the current price is more than 30% higher than the 50-week moving average. Nvidia has been one of the strongest trends. Now, you don't necessarily need the moving averages to tell you that. You can look at the stock and see, okay, it's gone from 30 to 100. Obviously, it's been a strong stock. But where that helps us is if Nvidia has a big time crash down to 85 randomly this month or something, just throwing that out there. If it falls quick and fast, we can say, hey, this stock's been so bullish. We've still got a ton of space between those weekly moving averages to speak to that bullish trend. You can kind of step in there and catch the knife versus a stock like Apple, which doesn't have as much space between the weekly moving averages. The reason? Well, Apple's made a great move over the last 5 weeks, but if we look at Apple over the last 3 years, she's actually been kind of flat. She just now got cleanly above those 2014, 2015 highs for Apple. So space is important. The more space you have between moving averages and current price tells you that the trend has been stronger.